So, why does the local economy matter? Well, the economic health of where you're looking to invest has a huge impact on the demand for both rent and for sell products. It influences your tenant stability and their ability to pay rent on whatever space they're renting from you. It also impacts your ability to sell the product because the buyers in that market, if the economy's not strong, may not be able to pay as much as you're asking for it, may not be able to qualify, or may be in a fluctuation of job insecurity or feeling like their job might be insecure at any moment, which makes people less likely to invest and buy houses or upgrade to a nicer apartment or rent an office space. If you're not really sure a year from now if you're going to still have income, people are a lot more cautious on the spending side, which impacts your long-term appreciation value of the property. And it also impacts the investment risk on the property when you analyze it. If it's an area that's going to take a lot longer to sell, or if the rents are kind of soft, you need to take that into account when you put in an offer on how much to pay for the property.
Welcome to Real Estate to Freedom, the podcast that helps you create the active life you've always wanted through passive income investments. Now, here are your hosts, Dr. Nate and Becky Lambert.
Today, I wanted to talk about location and why location matters in an investment. This matters on both residential and commercial, and on all different forms of commercial, whether you're looking at doing office space, retail space, warehouse, flex use, multifamily storage units, or anything else. The location in which you choose to invest really does matter. I'm sure most of you have heard the phrase location, location, location. It's because it really does matter. It has a huge impact on your trajectory of the project and the future appreciation value of the project. So we're going to go through that today on how to identify a good location from a bad location. And I know this is going to some of it will seem obvious, and some of it's going to seem a bit overwhelming for a lot of people in the fact that we're going to be going through stuff that a lot of investors that I know do not actually take the time to look into this information. But when you do, it can be a big game changer between having a project that works okay, or a project that doesn't work at all, or a project that really just blows your projections out of the water because it's so much better than you were expecting. And the reason I want to go through this specifically today is because I know we have a handful of people who are looking at specific projects right now. And I want to walk everyone through how and what to look for. There are a lot of resources out there. A prime location can significantly boost your property's value and attract potential buyers or renters to the property. It impacts the appreciation value of the property. It impacts the market rents on the property, and this market rents not just on multifamily, but rents on office, retail, storage units. It impacts the occupancy of each of those different spaces, and it also impacts how long it will take you to sell the property. In some markets, if you have for example, an office space, you list it on the market to sell as long as your pricing is right. Now, obviously, if you list it way too high, it's going to take a lot longer to sell. But if your pricing is right, in a lot of markets, you can have that sold within 60 to 90 days. And in other markets, it might take you 1 to 2 years, depending on the market location of where it's located, how urban or rural it is, and the demand and the supply in that particular area. So why does the local economy matter? Well, the economic health of where you're looking to invest has a huge impact on the demand for both rent and for sell products. It influences your tenant stability and their ability to pay rent on whatever space they're renting from you. It also impacts your ability to sell the product because the buyers in that market, if the economy's not strong, may not be able to pay as much as you're asking for it, may not be able to qualify, or may be in a fluctuation of job insecurity or feeling like their job might be insecure at any moment, which makes people less likely to invest and buy houses or upgrade to a nicer apartment or rent an office space. If you're not really sure a year from now if you're going to still have income, people are a lot more cautious on the spending side, which impacts your long-term appreciation value of the property. And it also impacts the investment risk on the property when you analyze it. If it's an area that's going to take a lot longer to sell, or if the rents are kind of soft, you need to take that into account when you put in an offer on how much to pay for the property. Economic, employment, and job growth. You want to look and find out what's the average unemployment rate in this particular area. If it's got a really high rate of unemployment, that's a strong indicator of job insecurity or of potential challenges in the economy of the area. if there's a really low unemployment rate, you're going to have a strong demand for tenants to either lease the space or to sell the space. So that has an impact on your sales value. The job growth in that area, is it a high income sector? Are there a lot of jobs in tech, healthcare, finance, things that are traditionally high paying jobs? Or are the jobs that are in this particular area really low income jobs that are out there, not a lot of upward mobility for people? If it's a lot of low income jobs, just know that you're probably not going to get a ton of rent appreciation because people can only pay so much. And as they start to get skills to a higher paying job, a lot of them move to those where those higher paying jobs are located. So the job trajectory growth, is it all low income? Is it all high income? Or is there a nice break in the middle? If it's all high income, then know that you probably don't want an older property that you're not planning to remodel because the demand is going to be for nicer units. You're also going to have less people that rent in a high income area unless the sales prices are just astronomically high too, like New York City, for example. But traditionally, in the higher income areas, you'll have a lot more people who choose to buy their own home rather than rent. So that has an impact on it. Know what your median income is in the city and in the surrounding areas. And is it trending upward, downward, or is it stagnant? If your median income is pretty low, say like $20,000, and it stayed pretty stagnant for the last 3 or 4 years, you're in a really low income area. So if you're buying a housing project, you got to make sure that it's affordable for people who live there before you consider buying a housing project in that area. GDP, or gross domestic product, and how that is an economic indicator of growth. You want to check the city and the regional area for their GDP growth rates. You want to look for diversified economic drivers. So is it one big employer and everyone works for that one employer and there's little to no other jobs elsewhere? Because if so, that could open a risk for you. What happens if that one employer decides to outsource and move it to somewhere less expensive, like, Cambodia or Mexico or something? All of a sudden, you have a whole city full of people who don't have jobs that are likely going to have to move somewhere else. So make sure the job market is diverse, not just in industry sector, but diverse on employers specifically. You want to look for the presence of high paying jobs like a Fortune 500 company, good number of startup businesses, industrial hubs, any kind of announced expansion of existing employers in the area so that you can see what's the likely projection on the population in the future and are there good jobs in there. Okay, so outside of looking at the job market, you want to look at the neighborhood itself. This, you can do a little bit of it online, but a lot of this is boots on the ground. You need to be there personally to see and inspect this. I always go tour a property before we invest in it after I have run the numbers and make sure that the numbers indicate that it's a good project. When you go look at the neighborhood, what you are looking at, you want to look up the crime rates in the area, the average age demographics. Now, age doesn't necessarily mean to invest or to not invest, but it does help you know what type of product is most likely to be in demand in your particular area. If you're looking at buying a brand new build apartment building that's got, say, a computer hub for places for people to hang out and socialize, and it's got a swimming pool and it's got a whole lot of high tech stuff that's really cutting edge high tech stuff, but your average age in the neighborhood is 80, your product is probably not going to do quite as well as if that exact product was in an area where the average age is younger for people who are more likely to love the tech stuff. If you're in an area where the average age is 80, you want to be looking for products that appeal to people who are in their 80s, like independent living, housing that has social out areas that people can go gather and have activities, have games like shuffleboard and bingo, things like that. And obviously don't stereotype too much, but know that the age demographic of your area does have an impact on the type of product that's most likely to do well in your area. You want to look at population size, population trend, like we just talked about, and then product demand. If you're looking at providing a multifamily space, how much of that's already available? Are there high vacancy rates in the existing units that are out there? Because if there's, say, 50 apartment buildings in the area and the average occupancy is 85% for the year, not just for this very month, but for the year, that tells you there's already more supply than there is demand. Building another one is likely going to drop the rental rates that you're going to receive. Whereas if there's a shortage, then yeah, evaluate the numbers. And as long as you can build a new one and make it fit, awesome. If you're not building one, if you're buying one of the existing ones and the average occupancy rate is 95%, that tells you there's pretty good demand. Same with storage units, office, and retail. Look and see how much of that product is out on the market in relation to how much is how much demand is there. And the best way to identify that is talk to local appraisers who specialize in this particular asset class and look at what the average occupancy rates are. That's a really strong indicator of whether or not there's excess demand or excess supply. Okay, on location evaluation, talked about market trends. You want to look and see, are the property values going up on like single family homes, for example? And you might think, well, I'm buying an office space, so why does that matter? Well, it does because all of these sectors are connected. If the property values for single family homes is on the rise, there's a good chance that your rents on office space are also going to be appreciating or increasing because the value of the homes are going up. So people's purchasing ability, usually more wages, people have more equity in their home, which usually indicates they have good jobs in the area that are allowing them to pay more. You want to know if the property values are going down. If they're going down, then there's a good chance that your market rents for the commercial or residential space are going to be going down as well. Or if it's stagnant, if it's only been stagnant for a few months, no big deal. If it stays stagnant for the last 5 years, that's definitely something to take into account. What that indicates is you're not likely to get a lot of appreciation benefits from this project. And as a real estate investor, you want the appreciation benefits. You want to know that what you buy today is going to be worth more 5 years from now. Or, I mean, no one can guarantee it, but as much as you can, that it's going to be worth more 5 years from now because you're going to be able to raise rents and you're going to be able to, as the economy naturally improves, the average rate of inflation is 3% in the US over time. It does change a little bit from one year to the next, but say between 2 to 3%. If your property values aren't going up at least that much per year, you're actually losing money, not gaining money because of inflation. That's just not, you're not keeping up with inflation. You want to know, is this property in close proximity to amenities that would attract people? Is it close to good jobs? Is it close to restaurants and grocery stores and the kind of places people often want? Most people don't want to have to drive 30 minutes to hit a grocery store. So your rental values are going to be lower in an area where there's not a lot of amenities, unless there's a big natural draw outside of these economic indicators. So for example, if you're right outside of, say, the Redwoods National Forest in California or something, there's a lot of tourists that go there. Okay, well, know that you're probably not going to get a higher increase on office space rent because people aren't really renting it. You're not going to get much more demand on the long-term rentals, people living there for 12 months. But if you can turn it into short-term rentals on a nightly rental basis and your property is zoned for that and it's not been forbidden by your planning and economic development departments, okay, look at something like that. But that's kind of the rare exception on when sometimes being as close to proximity of grocery stores and employment, maybe it's not as important, but that's pretty uncommon. That really only applies to like the hotel space and the short-term rental space. And again, you want to make sure there's enough demand for that because hotels and short-term rentals are often very, very saturated markets. If there's demand, build it. But if there's not much demand, or if there's a lot of demand, but there's even more supply, you don't want to be fighting in those markets where the prices are constantly going down on the short-term rentals just to try to fill spaces, because that makes it hard to compete and you won't make near as much as you thought you would. A lot of people in the last 2 to 3 years have jumped out of the short-term rental space because they found that for all the hassle they're putting into it, in the end, they're making about the same amount as they were making having it as a long-term rental. You put one tenant in there for the next 12 months, as opposed to nightly rentals. Every market is different, so this is not the truth in every place. If you're close to a beach or close to a place where there's a lot of reason for people to want to go there, then that would not be accurate in that particular place. But if you're just in a normal everyday city, a lot of people are finding in quite a few markets that it's actually easier and just as profitable to do long-term rentals. When you're looking at location on where you want to invest, look at infrastructure and accessibility. You want to see what planned transportation things do they have coming up, like rail lines, highways, expansion of freeways, things of that nature. You want to know what their existing transportation is. How good is the airport? How accessible is it? Is it an international airport or a domestic airport? Do they have good public transportation and transit? Do they have good accessibility to other cities where people might want to be going? And in this particular location, is it in close proximity to those infrastructure features so that people can commute to and from work pretty quickly as needed? Because that does matter. Also, this is one that's often forgotten, and there's plenty of cities where this still really matters, but some of us in bigger cities, we take it for granted because we just assume it's everywhere. Don't make that mistake, especially if you're looking at an area that's not as much of a city as you might be used to. Your digital infrastructure also matters. Do they have good internet capability? Because if internet's kind of spotty, that makes it really hard for people to work from home. It makes it hard for students who are taking online classes or students of any age or things of that nature. Communications really matter. I have literally seen, this is going to sound completely crazy, but once I explain it, you'll get it. I literally watched an assisted living center that was doing really well at one point. The owners switched out internet provider to save a few $100 a month to one that was a lot less. And in a matter of 6 months, their occupancy at the assisted living center went from 90, I think it was 91% down to 50%. Because those people want to be able to communicate with their family. They want to be able to watch movies. And if the digital infrastructure is not there, they'll leave and go to somewhere where it is. So take the time to look at your digital infrastructure and make sure that that makes sense. And if you're operating a multifamily space, a lot of times you can make money by selling data packages or internet packages. They usually call it a media plan, which will include like TV programs, internet, things like that. A lot of times it's in the past, it used to be cable, but a lot of people don't even use cable anymore. So look and see what your market is. But if the apartment community is offering an internet provider, but it's not a super reliable one, you're not going to make as near as much money as if you had a good, reliable one that you can negotiate a discount with on the internet provider. Okay, real estate market data to look at. We talked a little about this one. Look at current vacancy rates for that specific type of property you're looking at: office, retail, warehouse, multifamily. What are the current vacancies and how long have they been there? And are they trending upward or are they trending downward or are they staying stagnant? What are the rental rates? Again, increasing or decreasing or stagnant on the market rents on that property. Absorption rate and new construction pipeline. This does matter because if you have any one of those asset classes and there's a whole bunch more that's in the process of being built right now, your market rents are most likely going to take a dip while the market absorbs all of the new construction. And depending on how much is in the works of being built, your project might actually take a dip for a long period of time, or it might potentially up to 3 or 4 or 5 years while the amount of demand catches up with the surplus of supply that's out there in the market. Okay, here's one I want you to think about for a second, and then I'll answer it for you. What if you're looking to invest in a project that is just building new home starts, new construction? Do any of these economic indicators matter to you? Do you need to evaluate what are the rental rates? If you're not planning to rent it, you're just going to sell the property. Should you look at the rental rates of those properties if all you're doing is building new home starts that you're going to be selling to other people? You're not renting them at all. Does it matter? The answer is yes. It has a huge impact. Let me tell you why. A lot of you are in markets kind of similar to mine right now, where if you go out and buy a new build starter home, your monthly payment is going to be drastically higher than if you rented the exact same space from somebody else, the same size. So for example, around here, if I were going to buy a brand new starter home, say 3 bedrooms, 2 bathrooms, nothing super fancy, just new build, your monthly payment's going to be around $3,900 a month, $4,000 a month. If I went out and rented a 3 bedroom, 2 bathroom home that is either new build or close to new build, my monthly rents for that same home are going to be around $2,600, $2,700 a month. Do you see the giant gap between the rental rates and what the mortgage rates are going to be? What that does to your buyers of the new homes is it pushes a lot of them to decide to stay as renters because it's significantly cheaper. It's only $50 difference. It doesn't really have that big of an impact typically because most people are going to want to buy their own home and have their own home. This is my home. But if it's thousands of dollars different, most people are going to stay as renters because they can get more bang for their buck. They can put that money somewhere else and they still get to live in the home. So the market of the rental rates for single family home and multifamily has a huge impact on housing starts and housing sells. You'll notice a lot of home developers, they were doing amazingly well from like 2014 through 2022. It started to soften in 2021, well, late 2021 to mid 2022. It started to soften, but a lot of them still had a bunch of people in the pipeline who were super excited to buy homes. And a lot of people at that point thought, well, interest rates are going to come down, so I'm still going to get my contractor building my home. And by the time it's done, the mortgage interest rates will be lower. No big deal. Well, now that we're in 2025, and interest rates haven't really dropped much, a lot of people who were originally planning to build a home or buy a brand new home have backed off that market and decided, yeah, never mind, I changed my mind. It's too expensive. I don't want that much more in a monthly payment. And so a lot of home builders have either had to drastically cut back their products or or drop back their profitability on the products. I know quite a few who have actually just stopped building new homes altogether because what you buy the land for and what the cost to build the product, they can't sell it for that much, or they can sell it at close to that but almost no profit to themselves. So a lot of them are actually just sitting on the land they already bought and not building, or they bought land. Another thing that happened in 2023 is a lot of developers, they had bought land in 2019 when prices were low, and so they got it for a good price and it wasn't that big of a deal, they could still make it work. Well, now that we're in 2025, most of those home developers have already burned through all of their lower cost lots that they bought previously. Now they have to still pay top dollar to buy a new lot and pay top dollar to build it, which doesn't leave them much profitability. So a lot of them are not doing as well as they were before. So yeah, don't become myopic. We have far too many investors in the world who become myopic and think, well, I'm only doing office space. So I'm only going to look at office space. That's the only thing that matters to me, without remembering that every other industry in the real estate market has an impact on office space, has an impact on each other. They are all interrelated, and one city to the next is often interrelated. If you are in a major big city, but it's a 15-minute drive to where housing is significantly less expensive, that's going to decrease the demand for what you have as a product here because people can get it cheaper 15 minutes away. And most people would rather commute 15 minutes and save a bunch of money on rent or save a bunch of money on the cost to buy a home. So they are all interrelated. It is very important to evaluate all of it so that you can identify potential risks to your product in the future. When it comes to the economy and the location of where you are looking to invest, you want to look at economic concentration risks. How reliant is this place on one specific industry? Or even worse, one specific employer? How reliant are they on just the tech industry? Do they have a lot of other jobs, or is it just the one? Tech, especially, I'm using that as an example because tech is kind of notorious where they'll build up a bunch of tech jobs in one area, and then a few years later, another tech hub somewhere else will jump in. Everyone kind of moves to that place. And so the value of the area where that last tech hub was can sometimes take a hit unless that city is really good at continuing to bring in new tech jobs, new tech industries, and get people excited to continue to stay there. So it can kind of, tech can be kind of a fickle employer unless the cities are really, really good at managing it, providing property tax incentives for the tech industry to want to build there and stay there, things like that. The cyclicality of the local economy. You want to know, what is the local economy? If your local economy is very tourism driven and people come to this area, they flock to this area for 4 months of the year, and then it's kind of a ghost town for the rest of the year, that's a big deal. You need to know that because what are you going to do during the down season for income? You might be able to get good rents for 4 months, but is it going to be enough to cover the rest of the year? Or tourism dependent is a good example, but that's not the only one. Cyclicality of the local economy can have a huge impact on a variety of different things, but typically your tourism is the most cyclical. But think outside the box, evaluate the local economy and are there impacts that affect that. Sometimes it's weather related. There are some areas where they just get so much snow that a lot of commerce kind of halts for a few months of the year because there's just so much snow that it's hard to do much. That's not super strong. Even like in Alaska, there's a lot of people still typically fishing and stuff like that. But make sure the cyclicality has been taken into account. Environmental and climate related risks, which we just talked about with like Alaska, or areas where it gets so hot in the summer that there's not as much commerce going on. Although typically like Arizona is one of your hottest and it still does pretty well. So environmental and climate related are typically not as big of risks in this area. But for example, if you were looking to invest in Mexico, close to the equator, that might have an impact. So take that into account. Now I'm going to talk about the meat and potatoes of how to actually do this, because in theory, it sounds really great. But most people stop with the theory because they don't know how to actually look up this data. Unless you're an economist who specializes in this, how are you going to look up all this stuff? Well, you're in luck. I actually have a master's degree in econometrics. I'm going to walk you through how to look this up. There's a handful of different resources. The Bureau of Labor Statistics, for example, they can provide details on the job market, the diversification of the job market, the median wages of the area. You can look that all up online. It's pretty user friendly. That website's pretty good. The U.S. Census Bureau, which I know a lot of you might be thinking, what on earth? It will give you the population size, yes. They also keep reports on the number of building permits that have been pulled and for what type of industry. So that can be a good place to find out what building permits have been pulled and therefore know what projects are coming up in this particular area. They also do some population projections, so they can tell you not just where the population's been, but where they're projecting it to go, trending, things of that nature. Your Board of Economic Advisors for the city or the state, your city or state might call it something slightly different. Office of Economic Advisors, Board of Economic Advisors, Mayor's Economic Advisors. It doesn't always have the word advisors. I'm trying to think of some I've seen that didn't have the word advisors. But basically, most every city is going to have a group of people who help the governor, the mayor, the city evaluate the economy and set plans on how to improve the economy. That group specializes in helping plan out future infrastructure, both digital and infrastructure like roads and railways and airports and things like that. They also specialize in helping the governor, mayor, city council, whatever it might be, to try to attract new employers and to try to offer incentives for that to happen. They help the governor allocate out space and say, okay, we're not going to let this land get developed because we need a city park or we need whatever that does to kind of create the type of housing that they want. Not necessarily the houses, but if there's a park here and a bunch of homes around it, that's the ambiance or the type of environment they're looking to build. They work directly with the city planning and zoning departments, so that's another great one. Your city planning and zoning department for where you're looking to invest, just call them on the phone. These guys are actually, most of the time, they're really nice. Same with the Board of Economic Advisors. A lot of cities, especially the bigger ones, the Board of Economic Advisors will actually publish reports that are available on their website, either for free or substantially free. I've seen cities where they charge $3 a month. $3 a month is almost nothing for the amount of work they put into that. That is $3 well spent. Your city planning and zoning department can tell you about new construction starts, new plan developments for the area. They can tell you about infrastructure that's coming in. They can tell you about the zoning on a particular property. If you're looking to buy an apartment building and there's a big piece of open land that comes with it, you're thinking, wow, I'm going to build another 45 apartments here. Well, check with your planning and zoning department before you offer enough to take into account the building of those additional units, because some of them will say, absolutely, we're good with that. But you'll also find a handful of others where the reason it hasn't been developed is because it's not allowed to be developed. A lot of cities will say, okay, for every 5 acres of land, this is the amount of density that is allowed. And so a lot of those developers will leave a space open for like parks and playgrounds and pools because it's not allowed to be developed into additional units. So check that out before you jump into the idea of building another apartment building there. You can also identify from them, for example, if you have multifamily, if you're looking to buy multifamily, how much of the remaining land in this city and the surrounding area is zoned for the density that you're looking at. If the rest of it's all zoned for single family, that means they can only build up to 4 units on it. They can't build more than that on the rest of the land. So you have a commodity where there's not much demand because people can't build more without getting the city planning and zoning department to change it. Some city planning and zoning departments are pretty willing to adjust the zoning on a property to make it fit what you need. I would say most, in my experience, are not super willing to do that. It is zoned what it is. If you want it changed, there's a lot of steps that go into that. You have to put in a request to change it. You got to get the neighbors to approve it. Sometimes you got to get the neighbors to pack a city council meeting and talk about why they want this. A lot of times the city have put a lot of work into the zoning of that particular location because they want it to have a specific look and feel in order to attract the type of employers or tenants or people that they want into the city. So double check on that and see what your options are, but that could give you a pretty good indicator of likely future supply. If there's not much zone for that density, for much density, that could indicate that you have a pretty good product where there's not much supply capability. Now, if almost half the city is zoned for high density housing and there's a bunch of raw land, that might have a different impact. That might indicate that you are going to have some potential competition in the future, unless, of course, the new builds are going to cost way more. So we were talking about a project last night. So if you're in an area where to build new, in order for them to break even, they're going to have to rent it for, say, 40, 50% more than your current rents are on the property. If there's a housing shortage, but the cost to build is almost prohibitive because of the cost, by definition, your rents are likely to go up because the new builds are going to have much higher rents. And therefore, people oftentimes are willing to pay a bit more to be able to stay in something that's a little bit less nice, but less expensive. So all of those need to be taken into account. Here's some less common ones that people don't often think about, but are really quite useful. Building services department. Most people don't like these guys. These are the ones that come out and put the stop work notice on your building if you don't have a permit. A lot of people find them to can be, some of the harder departments to work with in the cities. I always go in and just be super nice and friendly to them, recognize they're doing their job. That is their job. So don't mistreat them. If you didn't get a building permit to build something on residential or whatever, usually this happens on single family homes when people try to remodel their house without a permit, things like that. But your building services department, they know a lot about new construction projects that are underway and planned units. So that's another place you can reach out to if your city planning and zoning is either too busy or doesn't respond back, or if your Board of Economic Advisors doesn't have details on upcoming starts. Your building services department usually will. If there's a university in the area, reach out to the university admissions department. Find out what was their student enrollment. How many applicants did they get? Is their student population growing or shrinking or staying stagnant? If they had more applicants than they accepted, so there's more people who wanted to attend than they were willing to accept, what is the university's plan for the future? Are they going to expand admissions, or are they planning to keep it right where it is and that's kind of their sweet spot of where they want to be? Because if they're planning to expand admissions, that could indicate that you have demand coming online in the future. So look into all of that. Okay, here's the easier ones to look at. There's a handful of market reports out there that give you pretty good data on office, retail, warehouse, storage units, and multifamily. If you're doing something really unique, it may not be on there. But those market reports, CBRE has good data resources. JLL has a lot of good resources. Colliers International, they're appraisal companies, and so they know what's going on. They track these for a living. You may have to pay them a little bit to give you that data. Totally well worth it, so that you know what's going on in the economy. Online tools, you can look at CoStar. CoStar keeps really great data on average occupancy, rental rates, and that's not just for multifamily. They do that for hotels. They're especially popular in hotels because hotels have a lot of data to track on a daily basis. I'm not going to go into depth on that one on this podcast, but if you're looking at doing a hotel, I'm not going to discourage you from it, but please know hotels are not traditional real estate. It's more of a service industry. A few bad reviews can tank your entire hotel. So you got to really track and monitor. It's kind of like babysitting your office staff, your housekeepers, making sure everything's up to standard so you don't get bad reviews. But on CoStar, they have great reports on average daily occupancy, average daily rents on hotels. They have stuff for short-term rentals like Airbnb, VRBO. They have great stuff on multifamily, average rents, average unit space size, average vacancy, how long a unit is staying vacant, how long it takes to typically fill a unit. Great stuff there. LoopNet can be a great resource as well. They typically list commercial properties, kind of like your multiple listing service on the commercial side. ESRI Business Analysts, they have some great data. There's a lot of great online tools. A lot of cities will actually have their Board of Economic Advisors publish all that stuff online. So look through that. But the last one, please do not discount the importance of looking at the property yourself. It is so important that you put your boots on the ground, because I have looked at properties that I thought were amazing properties. The deal just made great sense. All the math made sense. All the research online made sense. Then I flew out to go tour the property and discovered I hate it. It doesn't look anything like the pictures. It's really run down. The roof's in bad shape. The foundation's cracking, and the neighborhood is an absolute dump. Like huge levels of crime. I didn't even feel safe driving a car in the area. Suddenly, my perspective of the product changed. And the only thing that changed was that I physically went to the location and looked at it rather than looking at pictures that the seller wanted me to see. We've all been there before. Best example of this is kind of like dating. Everyone typically looks a lot better on their online picture than they do in person. When it comes to real estate, it's a lot the same way. People can stage a picture to make it look really great and hide the stuff they don't want you to see. You need to go there personally, see the product, see the market, look in the area. Driving the neighborhood not only tells you the crime rate, but it tells you a lot about the growth or the decline of the neighborhood, what's going on in this area. It lets you tour competitor properties, and you most definitely should do that. On the product, one of the properties that Nate and I are investing in right now, not only did I fly out to go see it, but I actually toured every competitor property. I showed up in the office, had their office staff show me units, 2 bedroom, 1 bedroom, 3 bedroom, just to look and see what are the rents, what's the condition of the properties, and to have them push to try to show me, are they showing me just the staged unit or do all of them look nice like that? So I could get a good indicator. I asked them, okay, so that unit looked really nice. Do you by chance have any apartments that are not really remodeled that are selling for a little bit less, that are renting a little bit less? And a lot of times they'll look at you, but then they'll show you some. And you can see, okay, in relation to my property that I'm buying, here are the competitors. Are all of them remodeled and look great? Or did they only remodeled a few of them and most of them are actually not remodeled? That tells you how much demand there is for the remodeled units. If all of the properties only have a few remodeled units, if you go in and remodel yours, there's a good chance you're going to get good rents out of them because there's not very many to pick from. Or are all the remodeled units in all the different properties, even if they only have a handful, if all the properties have a handful, but the remodeled units are just not renting much, then you probably don't want to put a bunch of money into remodeling your units because there's not as much demand for the remodeled units at the higher rental price. That's a pretty decent indicator that the market wages and the market rents just don't support the higher rents of the remodeled product. So look at that, tour the competitor properties, boots on the ground. I cannot emphasize enough the importance of seeing it for yourself so that you know what you're looking at. And when I go tour a property, I'm gonna be the first to tell you that I not only tour the property, tour the competitor property, but then after I've done all the hard work, I go enjoy the local amenities and things that are in the area because that helps me identify what are the draws to the area. And it's fun, and you get to write it off on your taxes. So Nate and I went out and toured a property in San Antonio that we invested in, and we had a bunch of clients invest in it with us. After we toured all the competitor properties, I mean, we started at like 5:30 in the morning. We toured the area, we toured the competitor properties. We put so much work into it. But by like 6 p.m., we were both exhausted and we had done everything we needed to do. So then we went on a nice little river tour around the San Antonio River, the main one in the downtown, took a little boat ride around it, got some dinner, asked some locals about stuff. We went and saw the Battle of the Alamo, all the tourist things that are there. And yes, you can write that off on your taxes because it's helped us identify the draws in the area. We didn't go spend the day at SeaWorld San Antonio, but we went and saw where it was. We didn't have time, we didn't have enough hours there. Otherwise, I would have happily done that. But knowing the draws of the area are in fact important to help you understand the likely market trends in this particular area. That concludes everything I wanted to go through. I just wanted to summarize the importance of evaluating the economy so that you can reduce your risks on projects, the importance of looking at diversification of the job sectors and of the amenities that are in there, looking at trends, not just the snapshot of how it is right now, what is it trending, making sure you're combining a quantitative analysis with a qualitative, meaning the numbers, and then the qualitative is the boots on the ground, go see it yourself. That's your qualitative. You can't necessarily compute it in numbers, but it is equally as important. And then choose markets with long-term growth potential if that's where you're going to invest, because your appreciation values are really important. Bureau of Labor Statistics, they're available online. That'll tell you your job market, diversification in the area, median wages, and breaks it out by sector, not just by employers. So it's pretty handy. You can see what percentage of the population work in tech, what percentage work in healthcare, what percentage work in as like at the education systems and so on and so forth. So it kind of helps you know what are the demographics of the people I'm trying to rent to or sells to. I think too many people think real estate isn't really a sales job, and we lose focus of the fact that you need to know who your avatar is. If your avatar is like you kind of want to know what's the rough age, what's their likely interest, what's likely drawing them to here, because that changes the product you want to provide to try to attract your target market. I mean, it's not your avatar matters. It may not be as important if you were selling a widget specifically, but it does matter. Keep your end user in mind. Just like when you're flipping a single family home, you don't want to flip a home and make it beautiful the way you would want it for your specific family needs. You want to catch as broad of a net as possible of what people in your market are liking. So if you really like having fuchsia pink walls in your kitchen, that's awesome. This isn't your home. You're trying to attract buyers, not figure out what you would want. And in a good, strong economy, when the market's going up, you can, I don't recommend it, but people can, in fact, skimp on their due diligence and their analysis and usually still make money because the market's appreciating so well. We are not in that market right now. We've been out of that market for about 18 to 24 months, maybe even longer, depending on which area of the country you are in. We're in the market where you need to do all of your due diligence before you invest in a product. You need to know what the economy is and why, so that you know how probable it is that you're going to make money. Because right now in this particular market, the ones who are making money are the ones who have done their due diligence before they bought it. They're not just banking on the values going up with appreciation. Over time, values do usually go up. Given a long enough period of time, there is some argument that values almost always go up. But some markets that might be 2 years, and some markets that might be 25 years for the going up factor. I don't know about you, but I'd rather be in a market where it goes up at a higher rate than one that's basically stagnant with a tiny bit of increase every 5 or 6 years. So that's why it matters.
Thanks for listening to Real Estate to Freedom with Dr. Nate and Becky Lambert. If you enjoyed the show, please rate and review on Apple Podcasts or wherever you get your podcasts. You can download their free ebooks and workshops by visiting realestatetoFreedom.com.